just because you can afford it doesn't mean you should buy it. And that's one of the biggest things we're seeing right now. People are missing mortgage payments and credit card payments and auto loan payments more than ever. And right now, missing the most payments, it's the high income earners, because they had a lot of money and instead of living beneath their means, they lived right at their means. And because of that, these high income earners, right, now that inflation has gotten so high and maybe they're making a little less money, now they don't have the ability to make these exorbitant payments that they signed up for. What's up, everyone? Micah Smith here. I am back with another episode of Rebuild and Rise. The last episode, we went over, initially I was saying 10 concepts in credit, but I took it down to 5 because I'm realizing how much needs to be broken down for all of these questions. So today we are going to be covering the second 5 biggest questions that we get in credit from our clients that you need to know to make you successful in your life. Credit is the cornerstone to building wealth. So we're going to dive right in. And these are questions that were actually asked to me from a podcast that I was on a guest on. And so I'm going to break this down and really dive in deep with all of you today. So what I wanted to go over is I actually wanted to go over all of the differences in credit scores. So one of the biggest misconceptions out there are, where do I find my correct credit score? So my niche is in the mortgage industry. And so we have people who are trying to buy homes, refinance homes. I teach real estate agents, brokers, investors, loan originators all over the country as far as how credit works. I literally will go into a loan originator's office and I'll look at a credit report and I'm like, move that, move that, move that. We're smarter than their simulators. Simulators are about 80% accurate, 20% like they're ineffective. So we can go in and look at a credit report and be like, move this, move this, move this, move this, move this. And we can help someone usually close a loan right then and there. And so, but one of the biggest things that I like to talk about is all the differences in credit scores. And so there are hundreds of algorithms. That's my favorite word. I love teaching it. I make everyone in my class repeat it, the word algorithm. So algorithm is just a fancy way of saying mathematical equation, right? So essentially, every industry is going to use a different algorithm to assess your risk, right? So let's just say you look at Credit Karma. I love Credit Karma. I have that as well as Experian, and I monitor my credit scores. What I love about Credit Karma and Experian is that they actually update every single day. And so it's a great way to monitor your credit for free. And 1 in 3 people will face identity theft in their lifetime. So it's a great way for you to be aware of what's going on when. So if you're looking at Credit Karma, they're using an algorithm called Vantage 3.0. If you're looking at Credit Karma, right, they're calculating things a lot differently than if, say, you go to a mortgage lender. So if you're looking at Credit Karma, right, you're going to see this credit score. And let's just say you've got a 700 with Credit Karma. Here's what you can expect. If you've ever had anything negative on your credit report hit within the last 7 years, you're probably going to see something very different with your lender than with Credit Karma. So on average, Credit Karma is about 40 to 60 points higher than what a mortgage lender is going to see. So mortgage lenders, the old algorithms that they use, you've got Beacon 5.0, Fair Isaac version 2, Classico 4. Okay, those are the names of the older algorithms. There are 2 new ones that were introduced. I'll tell you what those are in a second. Right, but the older algorithms, you're going to see on average are going to be about 40 to 60 points lower than what you're going to be seeing with Vantage 3.0. Remember, Credit Karma is a consumer scoring model. You cannot take this credit score and go buy anything with it. You can't walk into a car dealership. You can't, go to a department store and say, here's my Credit Karma. Go ahead and use this credit score to give me a credit card. No, it's not going to happen. When you want to get approved, you have to actually get approved through that lender and use their criteria and their internal algorithm, right? So banks are going to have their own internal algorithms. So if you want a credit card, usually it's going to be like FICO 8, the credit card model. And if you go to, let's say, an auto lender, they're going to use a different variation. They're usually only pulling one bureau, and each auto lender can oftentimes use a different bureau. Some will use TransUnion, some will use Experian, some will use Equifax. So you need to know, and you could pull different scores from, go to lender and see a different score when it comes to auto dealerships, because they could be using different bureaus. So there's a lot of confusion as far as like, why is my credit score so different when my lender pulls it versus when I see it? It's one of the biggest misconceptions. And so people have this misunderstanding that what they see here is what they're going to see everywhere else. And that's not the way it works. So scores are not transferable, right? What you see here is not what you're going to see there. So make sure you understand every industry uses their own internal algorithm to assess your risk. So if you ever want to know what your scores are at before you go to apply for something, say you want to apply for a mortgage, you want to apply for a auto loan, you can go to myfico.com. It's 100% accurate. It's a soft pull, right? Soft pulls do not impact your scores whatsoever. And in fact, we're going into our next question, which is soft pulls versus hard pulls. So soft pulls versus hard pulls. Soft pulls do not impact your score whatsoever. Mortgage lenders do have the ability to do a soft pull. A lot of them have reverted to doing soft pulls. And so a soft pull is not going to impact your credit at all. And it is 100% accurate. So if your mortgage lender says I'm doing a soft pull, it is not going to impact your credit whatsoever, okay? They can give you a pre-approval with a soft pull. So the resource that I wanted to tell you about is myfico.com. It's 100% accurate. So you can go there and you can get your mortgage scores. Make sure you request mortgage, which right now is 5, 4, and 2. Okay. Again, it's 100% accurate. So soft pull versus hard pull. Now a hard pull is, right, you actually want to go to apply to obtain a new debt. So you're like, okay, let's do this. So let's just say, right, you got your pre-approval with a soft pull. Now your lender is like, oh, you found the house you want to make an offer. Great. Let's do a hard pull to actually like get this ball rolling. So they do a hard pull. Now a hard pull is minimal to the credit score. So a hard pull is really only about 2 to 5 points. Sometimes it's a little bit more, but generally speaking, it's 2 to 5 points. And the great thing about the mortgage industry is that you're actually protected by these older algorithms. So 5, 4, and 2, they actually give you a 45-day shopping window, right? Essentially, so what that means is like, let's just say you go to a lender and you don't like them. Guys, here's one of the biggest things that I would highly recommend. Shop around for a lender. Mortgage companies are different. Banks are different. Brokers are different. Everyone's different. They all have different products. They all have different investors. They all have different overlays, which is a fancy word for a rule. They all have different things that they can offer you. And the people within the company, like they're all different. There are, just like credit specialists are hard to find good ones, it's hard to find good loan originators. Remember, they are making money off of your loan. So you want to find someone who has your best interest at heart, who's not only interested in the best loan for you, but the best savings for you, the best rate for you, not someone who's just like wham, bam, thank you, ma'am, like trying to get the deal done and doesn't really care what it costs you, right? You want to know what you're signing your name to, right? Remember that not all lenders are the same. It's every industry. You've got to be able to shop around. It's very important. So when you're shopping for a lender, here's the beauty of it. You're protected. So you can go from lender to lender to lender to lender within that 45-day span, and it only counts as one inquiry, right? So it's going to give you the ability to find someone that this is going to be probably one of the largest purchases of your life. Make sure you're comfortable with the person that is helping you with this loan. Make sure they're knowledgeable. Make sure that they're giving you everything that you need to know in black and white, in writing. Make sure you are very clear what you're signing up for. Make sure you understand the cost. Make sure you understand the interest. Make sure you understand the principal. Make sure that you're not getting in over your head with the DTI. So DTI is debt to income, right? Just because you can afford it doesn't mean you should buy it. And that's one of the biggest things we're seeing right now is we're seeing people. So right now, people are missing mortgage payments and credit card payments and auto loan payments more than ever. And right now, missing the most payments. It's the high income earners because they had a lot of money and instead of living beneath their means, they lived right at their means. And because of that, these high income earners, right, now that inflation has gotten so high and maybe they're making a little less money, now they don't have the ability to make these exorbitant payments that they signed up for. So just because you can doesn't mean you should. This is one of the principles of the wealthy. The wealthy live beneath their means. Just because you can does not mean that you should, okay? So I don't want to go too much into that because I'm going to have another podcast for you guys about how to follow the wealthy. I'm going to bring some people on and we're going to start studying some of the habits of the wealthy. All right, so we talked about soft pull versus hard pull, the differences, right, between all the credit scores. So what I want to make sure that we're discussing is I want to talk about how does paying off debt impact a credit score in the short term versus the long term. So what I want to talk about is, so yesterday I was consulting one of our clients and they were like, okay, so I'm going to go ahead and I'm going to pay off this auto loan and this is going to improve my credit score. That's not going to improve the credit score whatsoever. Okay. So if you pay off a mortgage, your score is going to drop. You pay off a student loan, your score is going to drop. If you pay off a personal loan, your score is going to drop. If you pay off a car loan, your score is going to drop. Why? Because the history stops calculating into the credit score. So what you want to focus on is you want to focus on paying off the credit cards, maximizing the credit cards, right? Which is just making sure that that utilization is nice and low. Every credit card you have should be at 6% utilization or less in the perfect world. That's where you should focus on putting your funds. And then in the interim, right, you can put your money towards the mortgage. You can put it towards, the auto loan every single month. That's helping you build up your payment history, but it's not going to move the needle in regards to credit score. I had one of my lenders, his simulator told him to tell his client to pay off $100,000 towards his student loan, and that's going to move the score 100 points. In no world does paying a student loan down $100,000 move the needle on a credit score 100 points? These simulators are so crazy, it's insane. Like I hate when I see this advice given because it's wrong. I study this stuff for a living and it's wrong. So make sure you are not applying your funds to move the needle on your credit score towards installment loans, which again, to recap on installment loans are anything with a fixed monthly payment, right? So you've got your mortgages, you've got student loans, you've got personal loans, you've got car loans, and sometimes, just FYI, so it does fall into the same category. American Express with no limit is a charge card. So that actually falls into the installment loan category. So, right, if you have a high balance on that, it's not going to be weighed against you in regards to your credit score. So what we want to talk about is closing out credit cards or keeping them open. That was another big question that I got. So when I do my classes, people are like, oh my gosh, I've had this credit card open for 25 years and I haven't used it as consistently as I would like to. And what we're seeing is people are closing out the things that are actually moving the needle the most. So one of the biggest things to know is that the older the credit, the better the score. And so they're looking for longevity. And so the biggest mistake that we see people make is they're closing out these really old accounts that are actually really keeping the scores nice and fluffy. And I don't know why I use that word, but it sounded good. And so essentially we want to make sure that people are not closing out old accounts. And so actually this was the case with my husband. My husband has this gorgeous credit card. It's super old. And when we started dating, he was telling me about his credit card. And I think I've shared with you, he put his credit report down on my desk and he's got this 840 credit score. And this credit card he has now, I think it's like 28 years old. And he was gonna close it because he's like, I never use this thing. It's old. It's like my first credit card. And I'm like, no, like, don't you dare close that. I'm like, that thing is gold. I'm like, keep that open. And so essentially it keeps his scores really, really high because the way that they calculate your length of history, which is 15% of your credit score, is it's an average of all of your open accounts, right? So as you open up new accounts, it can actually bring down the score a little bit. So having these really old accounts that you maintain forever, right, those are going to help offset like anything new that you might get. So right, when we got a new home, when we got our mortgage, or when he opens up a new credit card where he gets it for the fancy points and the cash back and the rewards, right, it's not going to suppress the score because he has so much positive now to offset anything new incoming that it's going to help the score. So if you have stuff that's really, really old, let's say you haven't used it in a long time, I've actually helped a few of my lenders close loans this way. I look at the credit report and I'll see that there's a really old credit card on the credit report. and I'm like, we need to use this. This hasn't been used in a really long time. So something that's been sitting there for a really long time that hasn't been used, sometimes it's not calculating into the credit score. And so sometimes what I'll do is I'll have people use it so it starts calculating and the scores will actually shoot up. I've closed quite a few loans that way. It's pretty cool when I get to tell someone to go spend money to raise their credit score. It's so counterintuitive. Like there's so much to credit that you would never even realize that exists. But again, this is stuff that I love to study and I love to help people find solutions. I can't tell you how many loans we've closed just by telling someone do this, do this, do this. And again, simulators couldn't possibly have the ability to know this stuff. And unless you're really good at knowing how to use a simulator, like even like the guys who use a simulator, we're like, listen, go through our classes so we can help you become better at what you do, because we want everyone to win. Like, listen, guys, when people get better credit scores, I'm in fulfillment and I'm in alignment with my purpose. The amount of free advice we give all day, every day, it keeps me alive. Like it's my favorite thing on the planet to do. The only other thing I want to discuss on this episode is I want to talk about what mindset shifts are necessary for someone to take control of their credit. And this one is something that I really wanted to talk about because the mindset shift that has to take place when you're trying to repair your credit is absolutely necessary. And I think this is going to be another episode in and of itself. But one of the biggest things that I talk about, so my background is fitness. I have a really, really intense background in fitness. I was in the Junior Olympics, I had a full-ride scholarship to college for volleyball, and I am a competitive bodybuilder. And one of the biggest things that we know in the fitness industry is you cannot outwork bad habits. But the same thing in fitness that we talk about when it comes to, right, you can't outwork bad habits. It's the same thing in the credit industry. You cannot outwork bad habits. And what I mean by that is this. So you heard already in this podcast how devastating it can be when someone lives outside of their means, right? When things get tough, right? And you've lived outside of your means, now all of a sudden you find yourself in a position when income isn't what it was. Now all of a sudden you can't pay your bills. And so the mindset shift that has to occur is, and we give people, actually, we have a 20-step, and this is going to be another episode, but we give people a 20-question survey where they can actually do a financial and credit checkup on themselves to actually get realistic with themselves to see where they're at. So the first thing that everyone needs to do when they're fixing their credit is fixing the mindset. People are oftentimes fixated on the small amount of money that they're going to have to pay to repair their credit versus the amount of money that they're going to save. So shifting into an abundance mindset is knowing that you're making an investment in yourself and in your future. When we hear people say like, oh, this is too expensive, when it comes to our program, like immediately disqualified, because I'm not going to sell someone as to why they should fix their credit, that they're going to make their money back 100-fold for the rest of their life. If they don't already understand based off of the charts, the graphs, the things that we've shown them, the things that they've missed out on, opportunities, if they don't already understand that they need to make a change, otherwise things are never going to change, then that's not a good fit for our program. So the mindset shift that has to take place, the first thing you need to understand is there's a cost to doing it, but there's a cost to not doing it. And we always have to ask ourselves, which price are we willing to pay? And that's the question that I want to leave with everyone on the podcast today, is everything in life, there is a cost to doing it, right? So there is a cost to repairing your credit, and there's a cost to not repairing your credit. How many lost out opportunities are you willing to go through in life? How much more money are you willing to spend unnecessarily, right? We already talked in another episode about how the average person is paying at least $1,400 a month in interest, right? Most of our clients are paying closer to $2,000 a month in interest. How much longer are you willing to continue staying in that broke capacity and that broke mindset where you're just giving away your hard-earned money every single month because you refuse to take on the principles necessary to learn how to be accountable, right? To start paying, everything on time, making sure that you're living beneath your means so you have money for a rainy day. God forbid something were to happen. You've got money stowed away so that way you're not frantic, right? When the paycheck isn't coming in that you so desperately need. So the mindset shift that needs to happen is you need to be willing to look at yourself and say, I am worth the investment, and I am no longer willing to sacrifice my long-term health for short-term gain. And we are in a microwave society where everything is about, I want what I want when I want it now. I've talked about with Fox, written multiple articles about the shift that we're going into right now, which is BNPL, the buy now, pay later. Interestingly enough, like one of the stocks that just surged through the roof just this morning is Affirm, which is, again, it's a buy now, pay later. And the buy now, pay later is if you can't afford it, here's this tiny little monthly payment that you can make, right, to buy whatever it is that you want. And they're even allowing food delivery services to start allowing people to finance their food delivery. And again, so you're going to have to learn to say no. And you're going to have to learn to live in a budget, and you're going to have to learn to live with below your means. It's really super important. If you want financial stability and wealth and freedom, I mean, my goodness, let's talk about freedom. The borrower is slave to the lender. Don't forget that. If you are constantly borrowing, right, and you don't have all of that money in your bank to pay that back, you are slave to the lender. You are no longer working to work. You are working to just pay your bills. So you have to shift your mindset, and you have to get real with yourself, and you have to say, what is it that I want long term? What kind of life do I want long term? What do I want my finances to look like? And you have to be able to say no to something that you want right now for the greater good of what you're going to want later. That is the first place you have to start with the shift in mindset. And you have to be willing to part ways with something small right now to have something much bigger and better later. All right, guys, I'm going to leave it at that because there is so much packed into this episode. I hope that you enjoyed. Please like and subscribe, guys. Listen, we grow our podcast by leaving reviews, so please leave a review. And if this resonated with you, if this helped you at all, please also share this with someone that you know would benefit from hearing this podcast. Guys, we're so appreciative of you joining us today. I am Micah Smith with Rebuild and Rise. I'll see you next time.